Hello, everybody. Welcome to the podcast this morning. We're just so delighted to be here with our very special guest. Um, I just had my notes open and I here we go. All right. Yeah, so this is a fundraising series to kind of talk about fundraising on a national scale. I'm delighted to be here with Brianna. And I'm the program manager for Venture Cafe, and I've been involved with many startups. And this is kind of an opportunity for entrepreneurs to learn about some fundraising strategies and success stories. Um, and then from that, I'll hand it over to Brianna, and she's going to introduce Bree.
Hi everyone, thanks so much for joining. I'm Brianna Patel, founder and CEO of Owl AI. I'm an entrepreneur, second time as well. Sold my previous company in financial services and public sector agencies. And I met Prem at an MIT dinner and had great conversations about how he's building businesses. So I was really inspired by that. I'll just start with a little introduction about Prem. He's a dynamic technology entrepreneur, MBA graduate for MIT Sloan, and CEO of Tandem. Tandem is a vertically integrated pet company that integrates digital pet healthcare tools with full service clinics to deliver seamless veterinary care. He has an extensive record of building and scaling companies from ground zero and has served as a head of product for Fizzback, which exited to NASDAQ listed NICE. He then co founded UB Cabs, a UK based ride hailing company that competed head to head with Uber. And then following that, he became founding CPO at Babylon Health, which later on went on to found and lead Day to Day Health, which was subsequently acquired by Babylon. So, we're really excited to have him here and hear about all his deep expertise in building multiple companies, scaling them, and successfully exiting. So, welcome, Prem. So excited to have you.
Thank you, Brianna and Trisha, for having me. And
Wonderful.
thank
So
you so
let's
much for your kind introduction.
yeah, so let's get started. So the first question we have is, so what gap in pet health inspired you to start Tandem, and how are you solving it differently with your products and services?
Oh, that's a funny story. Actually, so I grew up in India, never had pets growing up, and I was scared of animals like 3 years back. So, when I sold my previous company, I was just sitting at home and trying to spend more time with my daughter. And one day she insists on having this puppy, which was like bridge too far for me, is because I don't know if you grew up in Indian environment, there are no animals at home ever. So eventually her birthday came in, she kept insisting, and I gave in. I was like, okay, how hard it will be. And uh, we ended up getting this 12 weeks old puppy, Sammy. And for me, it was like just learning all the issues of what's happening. So what happened with my brain, if you think about it, on one hand, I have built and scaled two large scale healthcare companies. And on the other hand, I was seeing all the issues I was having with the Sammy's healthcare. So I was not a veterinarian or somebody who understand veterinary healthcare, but I understood healthcare operations. So I started understanding the problem deeply. I did a lot of floor work, working in the clinics, trying to understand the problem. Probably like I spent like 10 to 12 weeks working in different clinics, trying to understand the problem. And I thought then eventually, everything we have done in human healthcare is so relevant in animal healthcare. And then it's just organically from a personal problem to having a lot of free time, ended up one thing led to another, and we ended up starting Tandem. If you would have asked me 3 years back, probably animal healthcare won't be the thing which will be anywhere in my radar.
That's such a fun story. So, who are you building Tandem for first? Is it for vets or pet parents, or is it for both?
Uh, it's both. And the idea of Tandem is to use technology and integrated service model to improve the experiences on both sides. So while the pet parents have issues, the problem on the veterinarian side is not smaller. Like veterinarian is one of the professions with the, I think it's top three or four in suicide rates. Like most vets are underworked, and while the industry is growing, the vets are not growing that fast. It is predicted that whatever the vets we need, like next year, it will take 10 years to meet that demand. So even like with all the growing population, this problem is getting worse. And when I looked into this side, is like this is a perfect uh, problem to solve, where both demand and supply side have issues. So like we are using technology to improve the experience on both sides. We do a lot of work on the pet parent side to improve their experience, but at the same time we are also building a lot of tools and systems to help veterinarians. A lot of AI work has gone into improve vets life, like we do a lot of clinical record analysis, clinical record generation using tools and everything. So we probably save like 2 to 3 hours a day of vet's time with our technology.
Wow. That's amazing. So I'm gonna just ask the first question really about the fundraising portion. And so
Yeah.
what made you confident to think about fundraising in the pre-seed stage? And how did you come to the conclusion to raise like the large sum of money that maybe eventually got yeah.
Actually, it's a funny story. So when you were starting, like if you go back, we started in late 2022, early 2023 is, and if you go back that time, that was the worst time for fundraising. Like the interest rates have just gone up, the public markets were crashing, and like you virtually couldn't get any money. Like the market was really, really hard. Even the AI boom hadn't started then, so it was just like a very, very dry market. So it was not a great start for us. Uh, and what helped us in that point to also realize one thing which is very important is that from 2008 to like 2022, that like 13, 14 years of period, there has been different expectations and different way of building the companies, where the money supply was because of low interest rate and everything. The companies can take longer to break even and everything. What we realized that market has changed, and we were realizing it as a first hand, is that something which could have got funding 2 years back won't get funding now because the cost of money was much, much higher. So we had to really go back to the drawing board and think about all the different aspects of not only how do we create a growing business, but also how do we create a balance between growth and sustainability. And I think that has been a big shift on how companies were built before. Is like before we can build a business plan which could break even in year five, and now it'll be very hard to sustain those companies. Barring there are always some segments, like for example, there are some sub-segments in generative AI where a lot of funding is going. But if you think about the overall startup portfolio of different things which are happening, that pool is still very, very small. Like it looks much bigger in media, but it's not as big when you look at all the companies being created. So it was
Wow.
not a great start. We had to I remember like in October of 2022, we were sitting in the room and I was like, oh, we'll just make a business plan and let's just go and raise $10 million and we should build a company. And like this was probably the hardest fundraise ever in my career for this 10 million. I've done
Well,
bigger rounds, but this was the hardest fundraise ever, where we had to deeply understand the business. Because at the end, fundraising is about justifying how investors get their return. And that is the problem. I think people spend a lot of time on polishing the product and doing the right thing, but how will an investor get their money back? How do you survive if the market goes bad? Those kind of questions we had to answer, which was not the case before.
Absolutely, and so totally agree. I think the cost of capital is high in these times as well, and what you experienced back in those days applies today as well. I feel the expectations have definitely changed in terms of the rounds and the milestones. But how did you get investor intros for the investors that you didn't have connections with? And, if you can share more insights into how long your round was open for and how long did it take from start to opening, and how did you go about, uh, using both cold as well as warm approach in creating that network and connecting to the right people?
Okay, absolutely. Let's start with from building network first, because that is something I have invested like quite a bit of time doing it over the years. So, and there are two parts of that. The one thing is how do you get introductions, and then how do you nurture that network, and how do you keep people engaged and everything. So the thing is like being the luxury or lucky part of being in the Kendall Square MIT community is that you know a lot of people, and you also know the people who are not only like good themselves, but they can also introduce you to other people. So I have been maintaining this list of people for like last like 4 or 5 years, where like, okay, these are the people I can reach out. And every time you reach out, you also ask, okay, who are the other people you think we can talk to? Then you get some more introduction, and eventually I feel that's one area where people should start investing earlier. And this is something I learned from a friend of mine who runs a $400 million fund. And I was like, how did you reach there? And then I realized it's like uh, hard work of almost over 20 years of him to create that list, maintain that list, and he still meets all these people once every, like at least once in 2 years, like face to face. So that's like a good amount of job. So I will highly, highly recommend for all entrepreneurs to start maintaining a list of, and these people, can be investors, can be people who run incubators, people who may know potential people. So that's one part. The second part is now you've got the list, you can ask for help. The one, this it's a joke, but it's not a joke. When you ask for money, you get advice. When you ask for advice, you get money. So the reality is like, uh, people, and the science behind it is like people love to be part of a journey. Like they see where you started, what you are doing, what have you done, like how you are moving. And we at least I have seen people underestimating that part is while we all like are investors or entrepreneurs, we have our roles, but we also want to be part of a story of something started, all the ups and downs it has gone through, and to where it is. So the one thing which we did is while we had this list, we constantly kept them updated about what we are doing. Is simple things like we changed this location, we had an issue, the location has changed, we did this small feature and everything. So you know if you look at any of those updates, you will feel like, oh, there's like some change, not that much. But if you see those updates over an year, like over a long period of time, it actually looks a lot. Or these guys started from here, now this is like, so bringing people on the journey with you is very, very important. uh, so growing the network and engaging the network with your updates is extremely important. Like I can't you know, emphasize it more, is this is something we should start, like all the entrepreneurs, the moment they are on entrepreneur journey, they start, they should start doing it. I will, I have a version of the list which I created first time in 20, like 18, 17, that time. I had 5 people on that list, just to let you know. But now the list is more than 300 people I can email. It has taken like a long time, but that's like the investment it takes, and highly, highly recommend people to start doing it. And once you have them, you also keep them engaged about progress you are making. Does it answer your question?
Yeah, absolutely. I guess Tricia.
It kind of goes right in, yeah, right into the next question, which is like, what kind of traction did you build? And what you communicated to some of the your investor network. And were there was there one or two things that you could point to that brought you kind of over the edge to get you to where you are now?
Oh yeah, so that's a good question actually. More than traction, you also have some near-death moments, which kind of, the inflection where the traction happens is like, so the one thing I highly, highly recommend people, like, while you have some grand plans, how can you get some traction? So I'll give you a real life example of us. Is We had this plan of building integrated system, building AI tools and everything, and it will take 2 years to execute that plan. We're in after 2 years. But now, how do we get some traction so that A, we show that we are relevant, but also we start learning faster? Because traction has two different aspects. A, you start making some money, and you also start learning with real customers. So we tried bunch of different things. So the first thing we tried, I think February of or March of 2023, we launched a virtual care telehealth part of our service, because eventually you will have everything, but let's launch telehealth and see how it goes. It didn't go really well. The cost of acquiring customers was very high and everything, but we learned some things from that. The second thing which we did when it really worked is we went to all the apartment buildings in Cambridge and Boston area, and we asked for, like, can we organize a day clinic? Now think about it, like, day clinic is not the business we are in, but we are in the business of serving the customers. It provides us platform to test our booking systems, to test our clinical records, to test our note-taking systems, to see, like, the issues customers are facing, to see the realistic demand of what the demand is and everything. And so we started doing, those little experiments in the area, and the apartment day clinics suddenly, like, started working with like zero marketing. We'll go to an apartment building, we'll set up a clinic for a day, and uh, you know, we will put like 12 to 16 slots. And we realize is like the convenience was so high that most people will book the slots. And we also figure out one more insight from that is, for cat parents specifically, taking cats to vet was so hard that they loved somebody just coming to the apartment building and fixing it. So that part we did well, but then we realized, it takes too long to set up a clinic every day, because you have to move all the machinery, equipment, and then you take it back. There's a fridge, there's a X-ray machine, there are some vaccinations, so it's taking a lot of time. So then we were like, okay, what if we put everything on a truck? So we got these fabricated trucks which is like a full clinic. So rather than setting up in an apartment complex, now we can park it outside the apartment complex. So, and now it has something which was supposed to be just search for attraction anyhow, has become an integrated part of our go-to market, because now we can launch Tandem in any new city without opening a clinic, and the clinics can come later. So this is an example of while you have to always keep looking for traction, uh, think of it as an experiment. Some of it is not going to work, like our first telehealth experiment didn't work, but also like, the constant push gave us to explore something, innovative, crazy, however you want to look at it. But as we matured it, we developed something like, which is quite novel and helps us in a big way. Uh, it helps us to activate markets now. It helps us to understand the demand. Like we can park our, like, let's say we want to open a clinic in New Hampshire. We can launch mobile clinics and we can assess the demand in each area. And then we can decide where to build the clinic. So we ended up having a novel tool of ours. And in every business, there is that hustle, which has to be thought through of what is the mobile clinic equivalent for you, which is may not be part of your grand plan, but gives you something which you can quickly put in front of customer.
That's such a great story, and I can totally resonate with that because what you're saying is absolutely correct. You can only get to know so much by interviewing your customers versus shipping to them directly. So you learn a lot, while building traction, you're shipping to the customers and you learn a lot of new lessons. But what kind of early traction or signals did you have that helped you validate your idea before approaching the fundraising?
Yeah. So when we did our first, so fundraising, just so that you know, fundraising we have been doing in parallel, reaching out to people, and the outreach was never about, oh, we are raising funds and invested. We were like, this is what we are building, like, love your feedback or ideas about it. And I feel that's a lot more engaging because anything which you're doing in early stage is an opportunity for you to learn. And if you just say like, oh, can you give me the money and not give me the money, like that's a very shorter conversation, and it may not reach to lead to the richness which you want to have. And if it's a conversation about this is what we are building, what do you think about it? Some people will criticize, some people may like it, like, but they're giving you more data points for you to think about, which helps you polish your pitch and everything. So I will also take a fundraising outreach as an opportunity to learn.
Hmm.
And uh, I also feel like it has happened, but it hasn't happened a lot of time where I met someone who will just look at the presentation. He'll say like, okay, I'm done. Like I'm going to give you $5 million. It actually never happens like that. There's a lot more conversation. There's a lot more discussion. There's a lot more chemistry, like people understanding each other, has to take place before we even reach funding. So for me, like we were constantly doing the outreach, explaining about what we are doing, explaining about how things are progressing in parallel while we were doing it.
Wow, incredible. So like in terms of going to the data, what's different about your data room and how did you approach it? And yeah, we just love to hear more about that.
Yeah, so data room is simple. Like, there's a few things which you need to do is like, have your financial model in place, have your safe structure, your cap table, like, all the legal requirements. And that is something uh, we had our lawyers help us prepare that. They uh, gave us the right tools and everything. So few things investors want to see, like from a hygiene point of view, your cap table, like it's in place. What is the safe? If you decided like, terms you are raising the money, if you have any business plan, any deck, anything, if you have any financial model of how you go about it, your IP assignment documents, your non-disclosures, your contracts, like all these things, um, should be in place. It just kind of, it's a good exercise and it also makes you look more polished when you reach out to investors. We also had all the employee contracts so that people can see, what contract which person has got and everything. So we had legal help, and this is something I will highly encourage. Uh, in Boston, like most lawyers provide this. It's kind of not free, but they will give you some credits up to $25,000, and they can help you set up your data room, your contracts, your safe, and everything as part of that service, and you pay them when you have raised money uh, beyond a certain size. So that is something, I will highly, highly encourage people to do that.
No, that's great. Can you tell us a little bit more about financial model, if there are any, base templates or anything that you use to build upon? Will you model the projections on a more conservative side, or because um, it's all projections?
Yeah, the thing is, so I'll tell you the one thing is, uh, actually, this is something I've been on the investment side also.
Yeah.
So nobody actually really cares about, I mean, if it's like really crazy or really low, like people will care about numbers, like, just to see, like, at the end, you know, what people are looking at your financial model and they know that half of this will be wrong. Like, anyways, whichever way you go. If you're very successful, you can't predict that. If things don't go well, you can't predict that. And it's very hard to predict. But people like to see how you think. And everything you are putting together in front of people is a way to showcase how you have been thinking. What is the detail you have been thinking about? Like, how you have decorated your business. Because what happens is, your deck and everything is more about showcasing the business, but financial model is one thing which shows, like, in more structured way, like, how you're going to spend money and collect money, like the basics of the business. So again, numbers kind of matter but not that much. It's mainly about how you have been thinking. And uh, and the reason it is important for you to have something, it gives people a structure to have a conversation with you. It's very hard otherwise, like, if you just give a deck to someone and, like, what kind of questions they can even ask, how they can even understand. What you have to do is build everything to encourage conversation, to
Mm.
talk to people. And then those conversations is actually your opportunity to sell yourself and your company. So while, like, all of these things are tools for you to have a richer conversation with the potential investors. Does it make sense? Like, that itself doesn't matter, but the conversation it could lead to has, like, a lot more value than the tool itself.
Yeah, I love the idea of like the logic of your projections is
Yeah, the
really
logic of the projection. And then
amazing.
people can
Yeah.
criticize the logic. They may agree or they may not agree with your logic, but or they can give feedback on the logic. But the thing is, what people love to see is that there is some logic, there is some thinking. Is like, this person is thinking, this person, you know, may be thinking crazy, but there is some thinking. Is like, it's just not randomness and just like put something and find a template and just fill it in. It's not like that.
Mhm.
So if one of your question was about templates. Actually, like, I do all my financial modeling from scratch. It's just because, like, at the end they all look 90% same,
Mhm.
but like fine tuning it is very, very important for your business. So whether it's any of the business I've been part of, I just built them. It doesn't take that long to put
Cool.
a basic model in place.
Yeah, makes sense. Like, so what KPIs did you track when you're getting ready for fundraising?
So
Share.
the simple one, like the most important one, which like everybody wants to understand, is how much are you burning? Because they're trying to calculate how long the money will last.
Mhm.
The second thing, which we were like, uh, our early stage revenue, but in our early stage revenue, more than revenue, what is the month on month growth? So, like, at some point, we were growing around 15% month on month, and it was a very good indicator. And now the thing is, just to even write your month and month growth, you have to do so much work to even get that KPI right. So anything you can do which shows month on month growth is highly, highly helpful. Absolute numbers are very helpful. The one thing which also helped us is repeat customers. It took us 3 months to get there, but how many people are coming back? It's like a very good indicator of a great experience people are having. The one thing which you are asked a lot about the average transaction size of how much people are spending with us, very, very important. If you can project some kind of lifetime value of a customer based on that, it's especially for consumer companies, that's something which is extremely important. If there's a way to project, so like for example, our average transaction cost when we were operating a van was around $250, and we could easily project if this person comes twice a year and is with us for 5 years, like this is the cost of this customer we have acquired. So that really helps. Another thing, it may be more relevant for our business, is that when we were adding anything, how many people are opting for that. So for example, initially we started with the vet service, but then we also added a mini pharmacy. For us to see how many people are actually using our pharmacy was also very, very important. So when we were showing people, okay, like when we provide pharmacy, actually half of the people end up using our pharmacy. It means they trust the brand. There's a lower cost of adding more services, and it can directly go to the bottom line rather than just, something being very, uh, you have to invest marketing dollars to launch every new product. And then it ended up becoming integrate part of our story is that we can add more and more products with the minimal marketing. So these KPIs will be very different for every business. But the two lenses I will think about, or I will suggest people to think about is one is predictability. How your business is becoming more predictable when it comes to its revenues, its output, like anything you can do in that direction, and then growth. And third, which is more important right now, is sustainability. Like you can sell like a $10 note for $9, and you can be perfect in first two KPIs. You can grow really, really fast, and you can sell even $20 note at $18. But the reality is you also have to be growing sustainably.
Absolutely. That is such a good point. But now that you have completed your fundraising, what are your next milestones for the upcoming 6 months to a year?
Yeah. So right now we are about to open our first hub this week. Our plan is to have four more hubs in Greater Boston area by end of next year. So we are planning 20 million round. And just to also let you know one more thing, which I think I should have talked about, is when people look at a capital pool, at least even like I've learned these things recently. Like I've been an entrepreneur since 2006, but I learned few of these things recently. We think of capital pool as equity investment as the only pool.
Mm.
It's like you go to investors and you go and raise money and everything is, but the one thing I will also highlight is equity is probably the smallest pool you have access to. Uh, it would be very important for somebody to understand is what is the use of these proceeds. Is like, for example, like, let's say You are building an energy company, uh, and bulk of your investment is going to go into building data centers. Okay. So now if you see like two things are mixing here, a physical building versus technology and like, bunch of other plays. And if you think about use of proceeds, each use of proceed can have a different class of capital it could have access to. So for example, for construction, you don't need to have equity money. You can get debt for construction. Some equipments you're trying to get, you can lease those equipments. So there's a more flavor of capital available than we understand. So when we raise money, we always create different classes. How much money we will get on debt, how much money we will get as lease, how much money for equity, and then we do this distribution. So for example, anything with tech development, marketing, people, it's all equity. Anything related to construction, equipments, it's all debt. Anything where we can lease the equipments and figure out a structure, we will go and lease the equipments. So I will highly recommend people, where it is allowed, to be a little bit more granular about their fundraising strategy and trying to figure out what are your real use of proceeds and which classes of capital are applicable for each use of proceeds.
That is so important. And also,
Yeah.
seed funding is not the only route. There's family office,
Yes.
there's sources as well. So those are all
Family offices in the US, there are grants, like with the new administration, I don't know what the status of grants is, but grants used to be like a big part of where you can get capital. There are small business administration supports in the US for people who are at least US citizens when they're starting the business. So I will highly encourage people to do little bit of research on which other capital pots they have access to. And this is something which I learned hard way. Like there are much more capital available than we think it is available, but it also, you know, takes a lot of granular analysis to understand where we can go. And in fact, using equity for everything is not the smartest way because equity is the most expensive capital you can get access to.
Uh, that's good to know. I mean, that's it's a great perspective. And so actually kind of on that, um, kind of continuing with that, like I'm curious about a successful rejection that you've had that allowed you to pivot.
Oh, like I'll say like uh, it's a joke, but I say like, if you'll be lucky to have more than 6% success rate with these conversations. Is like, so
Mm.
be prepared to be rejected more than you think you will be rejected. But 6% is actually a very good rate if you can hit like sometimes like we even meet people where we know they're not going to invest in our company. Like we know before we even meet, but we still go and meet and something comes out of the meeting. So for example, like I'll give you two examples where I knew for sure that like in two different cases, these people won't invest in us. But we went to both the meetings. In one meeting, we got like a really solid introduction to somebody else. And another meeting, there was a third person present in the meeting who ended up joining our company, even if the primary guy didn't invest like in us. So being out there is like the biggest thing you can do. Like I always say to people, like the the biggest job as an entrepreneur you have is just to show up. Just showing up is like a big part of fundraising. What happens is the most people think of it as a highly curated intellectual exercise, which there's a part of it,
Mhm.
but there's a huge part of it is just showing up. Like, everywhere, and then like, connecting all the dots, which is also very exhausting if you think about it. Like, how many places you have to show up, like, wherever it is. But uh like it's still these serendipities happen all the time in my life.
Hmm. Yeah. I know that's the joy of working at Venture Cafe because it's, helping curate that. And
Yeah,
then it's
absolutely. And
amazing who we meet
I
like
highly
every week.
recommend people going to Venture Cafe every
Thank
Thursday.
thank you. Um,
That's so true. It definitely is very exhausting to be everywhere. But curious to know, since you said that only 6% of these conversations, if you're lucky, if 6% of these conversations convert, what are some of the most standout objections that you have come across, and how do you actually, as an entrepreneur, handle those objections?
Okay, yeah. So I'll give you like one of the real ones is when we were start. So right now, if you think about, everybody talks about vertically integrated AI companies. Like this is like a new buzzword, and like, Vice is talking about and everything. Uh, we started building a vertically integrated, pet company in 2022. And that time, this idea was like not anywhere, it's not a mainstream idea. So we will get a lot of pushback from people is just build a tech, don't build clinics, just sell tech to the clinics, or just focus on clinics, and you're trying to do too much, and all those kind of feedback you will get. So you go through two parts in your brain. Is one, how do I pivot? Or how can I show some early data to prove that I am on the right track? And the one thing is, people who are not convinced, you're not trying to convince them. The main thing is, like, if somebody says like you should just become a tech company and sell technology to clinics, which I used to do before in my previous company day to day, and I have like a understanding of those challenges also. But what happens is you won't be able to, overcome those biases. And we all have our biases. Like, like investors are also people, like, they have their own biases. So, like, if you ask me, I won't fight that battle. I'll be like, okay, like, like these people have the rationale, they have, their thesis and everything. But what I will try to understand is, how do I prove? Like, the bigger takeaway from me in that conversation will be, okay, how do we show that vertically integrated model is a way to go? Like, what is the early data we can show? So for us to launch telehealth and on-site clinic and apartments, the combination, and show that when we go on-site, people also use our technology. When people use our technology, they also want to meet us on-site, was a way to have some small data points in that direction. So uh, in this case, we didn't pivot like as a business, but it highlighted that how we could think better of communicating this constant pushback on a vertically integrated model. And today nobody talks about that stuff anymore. So it's also, things change. Now everybody says, "Oh, this is the way to build business. You go vertical integration." But if you ask, like 2 years back, like 99% of the pushback we were having was, it's too hard of a business to build.
hmm.
I just want to push you further before Trish asks the next question, Prem, is that do you have any obnoxious objections that have been asked in the past?
Oh
I
yeah, yeah, that happened. The thing is, that's like
think
human.
that's really not relevant.
That's human. Like, you don't know what kind of day somebody's having. Like,
Yeah.
like I kind of smile and move on. Like, you can't take these things too much in your heart. Like, I was in one event.
It was one
I was
funny one.
like, it's just like, like somebody, I don't know what was, like, maybe she didn't like pets or something, and he was like, we are building this, and he was like, why the hell world needs another vet clinic? It's like, so I was like, okay, like, she's not my customer. I'm not going to sell anything to her. Like,
Yeah.
there is no point. And you can just say, yeah, you have an interesting perspective and like move on. Like, you're not trying to, you can't keep fighting. That's the one thing is, you know, while this is all serious, you should also have some sense of humor about all of this.
Right.
It's like you will meet, these people anywhere. And the thing is, it's not just investment. You will meet these people as customers. You will meet these people as friends of friends. Like you'll meet these people in life. So like investors are at the end people. Like they are no different. And sometimes somebody may be having a bad day. Like you don't know what happened in their personal life. So their reaction may not be to you or your business or your pitch. It may be something which happened. So yeah, just take it easy. Like I always tell my team that don't take yourself too seriously. Like keep a sense of humor about everything.
Yeah, I love that perspective. Yeah. Because it's a marathon, not a sprint,
It's
right?
a marathon, like you keep running and like, some things will fail, some things will not work out. And
Yeah.
some days you will also screw up. Like, be open to that like also. Like you're also human.
Yeah.
Like, there will be times where you will also screw up. Like, you will mix the thing, you will say the wrong thing. So, and even the thing is, errors here and there don't really matter. What happens in the long term? Are you learning? Are you getting better? Are you learning? Are you getting better? Like, that's what matters. Everything else is just like blips here and there.
Hmm. Yeah. Um, the question I have is at the pre-seed stage, some investors get involved only after a slide deck, only after like a slide deck, they're like, yes, or while others have to like pitch. So what's kind of driving like those differences of an experience for folks? I know there's a number of different
Yeah.
factors. I'm
Yeah,
curious.
this is a very interesting question. So, like, there's a joke in a fundraising, like entrepreneur community, like three kind of people who will give you money as like friends, family, and fools. Like in an early stage. So it's like, see what happens is when you're starting early, it's nothing. Like so. Uh, People have to believe in you like okay whatever Trisha does it's going to be amazing. The reality is nobody even understands your business at this stage. It's like that's where like your personal brand, how do you present yourself, that also comes into play. You cannot take the human side out of it because all the early investment is I would say like 60-40, 60 in the founding team and 40 in the business, maybe higher. Like there's no mathematical way to prove it, but it's a lot on you as a founder, founding team, and business. They are like pretty, so that's why building personal brand for founders is very, very important. I used to be I'm still like very private, very shy kind of a person. If I go to the event, probably won't speak too much with people. But I had to learn like, that building a personal brand is very, very important. Is at the end, people like to meet and talk to other interesting people. That's how like the world operates. So I know this is not the answer of your question, but the reality is for the initial traction, there is no like, okay, you go there, like maybe you can go to incubators and something, they give you a pedestal, which helps a little bit. And if you don't have access to like, YC or Techstars or any of these places, at the end, even what they are doing is curating. They are saying, okay, out of 10,000 startups out there, these 100 are the curated ones. So people go and meet them, they give more time. That curation you can also create by having your own personal brand. At the end, you have to say, okay, these 10,000 companies out there, I am like a step or two above that.
Hmm.
And that curation can happen multiple ways.
Yeah. But there's also like this, I feel like there's this idea that you can have a business, you walk into a meeting and then you walk out with like $15 million. So I think maybe, correct me if I'm wrong, but it seems like you're saying that really doesn't happen. It's either through
No, no, it
reputation.
happens. Like people get lucky all
Uh-huh.
the time. Like,
Uh-huh.
so that happens. It's not like it doesn't happen. I'm talking about more like general cases.
Hmm.
So people happen, like, these things happen. People walk away with $100 million, but you cannot create your strategy on that.
For that.
Your strategy have to be created on a lot more what is normal.
Yeah.
And then if you get lucky, that's amazing. Like,
Do you think it's from
somebody.
like, sorry, go ahead.
So what happens is those kind of things happen when two things meet. Like an investor who really knows what you are doing, who really likes you as a founder and understand the space. And they were like, I was waiting for something in this. And then the founder, business, investor domain, they all meet amazingly. So then it's
Hmm.
like spark. What happens is there is no scientific way of figuring out like how do you do that, because that's almost like serendipity, magical. Like it happened with us. Like we got literally $1 million out of this from someone. Like we didn't even show the slide deck
Mhm.
to, uh, because they were looking for some company in their space. And like, we just sat down, we had a conversation, and they were like, okay, count me in for $1 million. Now, will I say that was the strategy? Like, no, like, that is just, it happened. We got lucky. This person was looking for something because they have certain other incentives, like, what they're trying to create. The person lost their dog because of something. Is like, so those kind of experiences will always be there. So luck always plays a very important role. It's just the luck is not a strategy.
But you tried a lot to meet with these kind of people, so trying harder made
So,
you.
you try to meet people and sometimes you get lucky.
Yes.
So, and you just won't know when
Yeah.
it is going to happen. So, which means, like my previous point, bulk of it is just showing up because you just don't know.
The numbers
Like,
game. Yeah.
what it's just like, and uh, this is like the biggest part of a founder's job. That's why it makes it so hard that on one hand, you have to do your work, but then also you have to just show up everywhere.
Hmm.
Absolutely. That is so important. But with that, thank you so much, Prem. This is such an enlightening conversation. And
Thank you. Thank you so
we
much.
appreciate your time and all these insights. And hopefully, it's very helpful for everyone who's going through the fundraising journey or raising in the current season. But we just wanted to open it up for anyone if I know a few people could join. So if you had any questions, feel free to, ask them away. And if not, then we can
Or
wrap.
put them in the chat.
Yes, put them in the chat.
Thank
Okay.
you, Dee.
Thank you, Dee.
So I guess no more questions. Is someone trying to say something?
Yeah, hey, thank you so much for setting this up. I'm going through C Brown. I am just really curious, if you can share like the biggest hurdle you had to face in the process of fundraising.
Oh,
Uh,
I mean, I can go on. Like, imagine like this is my fifth company. I probably have done like, 20 different fundraising round. The okay, the funniest I've ever heard is like, I'll tell you. So I met this investor, uh, and he won't say yes or no. Like, the thing is, you want to hear yes or no and move on. And I was like, and one day I asked, like, just tell me like which way you are thinking. And I'm not joking. I'm telling you exactly what he told me. He's like, every morning, 5 a.m., I meditate. And if I see the light, I decide to invest. If I don't see the light, I don't invest. And I was like, oh man, like, how do we know that you see the light? Like, because it's not based on anything. So the amount of BS you are going to get is just like is. But the thing is, you can have a sense of humor about all of this and just keep moving.
Thank you.
A
There,
question in the chat. Yeah. How do you, from Vishal, how do you know when you when you have de-risked enough to find product market fit?
Uh, so this is a very good question. The first thing is, Vishal, I don't know what your business is. It's different for different businesses. Uh, so for example, in our case, I can take example of Tandem. Like when we started doing our clinic service in the apartments, that was like our the product market fit movement. Is we all sat down as a team and we were like, we have 16 slots to fill. H- How many slots have to be filled for us to consider that we are going to be success or not success or failure for us to decide? And we did a team vote, and somebody said 4, 6. I was the most optimist with 8, and we ended up filling 14 slots that day out of 16. So those are the moments where you know, okay, this part is de-risked enough, because now you know with the 14 slots filled, you can run that operation with profit. The whole company won't be profitable, but that part, and now you can scale. So for your business, it's going to be specific to what your business is, but figuring out the unit where scaling won't lead to more losses is where I will say like you're in the early stage of finding a product market fit.
That's great advice. We have another
There's one
question.
more. How do you evaluate the amount to fundraise early and whether the trade-off is worthwhile for the typical advice seems to be fundraising as much as possible. Uh,
Let me repeat the question. So this question is from D on how do you evaluate the amount to fundraise early stage, whether it's pre-seed or seed stage, and whether the trade-off is worthwhile for the founder. For example, the typical advice seems to postpone fundraising as much as possible. However, it might sometimes depend on how competitive the market and the race is.
yeah, that's a very good question, D. Like, so I can tell you my personal bias. This is a bias because like I delay fundraising as much as I can. Uh, but at the same time, I have also matured as an entrepreneur. Like when I started earlier, I was like, let's just feel secure and get as much money as we can. And we ended up making mistakes and like, doing all that. So it is a very personal preference. And the reality is, the question you will have to ask yourself is how much risk you can tolerate. Because whichever side you go, there's a risk. If you take too much money, the risk is you losing the control and like all the other things which come. Dealing the capital means is like, you're taking a risk that if the market shifts or something, you know, you may not get the money. So this part is actually like very, very specific on how much risk you want to take. My personal preference now, after some experience of doing this, is to delay fundraising as much as we can. And then there's even like a class in that. So, for example, like, I try to delay like institutional fundraising for as long as I can, and going with more family offices and private investors. So, like, again, it depends upon your stage, depends upon your comfort, but it's not an easy decision. And whatever makes you sleep better and you feel like I can live with this much risk is the right place to go.
Great. I guess we are at the top of the hour. So thank you all so much for joining. Thank you again, Prem, for sharing all
Thank
these
you.
insights. And it was great.
Fantastic. Thank you. Yeah.
Thank you. Thank you so much.
Thank you.
Everyone have a great
Bye.
day. All right.
You too. Bye bye.
Bye-bye.